Think of it as a Google Doc that everyone can see, but no one can edit or delete once an entry is made. You can only add new lines to the bottom. How blockchain works. The process relies on a specific sequence of events to ensure security and transparency without needing a central authority like a bank. 1. The transaction. Someone requests a transaction. This could be sending cryptocurrency, digital art, or even medical records. This request is broadcast to a peer-to-peer network consisting of computers, known as nodes. Verification. The network of nodes validates the transaction and the user's status using established algorithms. A verified transaction can involve cryptocurrency, contracts, or other information. The creation of a block. Once verified, the transaction is combined with other transactions to create a new block of data for the ledger.
महंगाई हर साल बढ़ रहा है, इसलिए सिर्फ सेविंग्स पे डिपेंड रहना काफी नहीं है। फाइनेंशियल प्लानिंग के लिए जरूरी है सही प्रोडक्ट्स का सिलेक्शन और डिसिप्लिन इन्वेस्टिंग। एस्पेरो आपको फिक्स्ड इनकम इन्वेस्टमेंट ऑप्शंस एक्सप्लोर करने का सिंपल और ट्रांसपेरेंट प्लेटफॉर्म देता है। एस्पेरो एक बॉन्ड इन्वेस्टमेंट प्लेटफॉर्म है जो रिटेल इन्वेस्टर्स के लिए डाइवर्सिफाइड फिक्स्ड इनकम एसेट्स को एक्सेसिबल बनाता है। यहाँ आप डिफरेंट टाइप्स के बॉन्ड्स में इन्वेस्ट कर सकते हैं जो प्रेडिक्टेबल इनकम और पोर्टफोलियो बैलेंस में मदद करता है और इन्वेस्टमेंट शुरू करना बिल्कुल ईजी है। एस्पेरो का जीरो डॉक्यूमेंट अपलोड केवाईसी प्रोसेस सिर्फ 2 से 3 मिनट में कंप्लीट हो जाता है और पैन और बैंक डिटेल्स को वेरीफाई करिए और आप इन्वेस्ट करने के लिए रेडी हैं। अगर आप फिक्स्ड और क्रेडिट क्वालिटी को प्रेफरेंस देते हैं तो एस्पेरो पे AAA रेटेड बॉन्ड जैसे ऑप्शंस भी अवेलेबल है। हाई क्रेडिट क्वालिटी इंस्ट्रूमेंट्स, फिक्स्ड इनकम ओरिएंटेड रिटर्न्स और फ्लेक्सिबल टेन्योर, शॉर्ट टर्म से लॉन्ग टर्म तक आपके प्लानिंग के हिसाब से। और सबसे इंपॉर्टेंट बात, एस्पेरो से भी रजिस्टर्ड है, सारे ट्रांजेक्शन सिक्योर होते हैं और बॉन्ड्स डायरेक्टली आपके डीमैट अकाउंट में क्रेडिट होते हैं। तो आज ये एस्पेरो पर जाकर फिक्स्ड इनकम इन्वेस्टमेंट ऑप्शंस एक्सप्लोर करिए। डाउनलोड दी ऐप नाउ।
Fixed returns do not constitute guaranteed or assured returns. Investments in corporate debt securities, municipal debt securities, or securitized debt instruments are subject to credit risks, market risks, and default risks, including delay and/or default in payment. Read all the offer-related documents carefully.
In the simplest terms, a digital asset is anything that exists in a binary format and comes with the right to use it. If you can't touch it physically, but it lives on your computer or in the cloud, has value, it's a digital asset. Gone are the days when assets only meant gold bars or property. Today, your digital footprint is likely packed with them. What qualifies as a digital asset? To be considered a digital asset, an item generally needs 3 traits. It must be digital, uniquely identifiable, and provide value either personal or monetary. How it works, the ownership engine. The mechanics of a digital asset depend entirely on whether it is centralized or decentralized. Centralized assets the old way. Most everyday assets, like a movie you bought on a streaming platform or a photo on social media, work through centralized databases. 2. Decentralized assets the new way. This is where things like crypto and NFTs come in. Bitcoin mining is the process by which new bitcoins are entered into circulation and the network's decentralized ledger is secured and updated. It isn't mining in the sense of digging in the ground. Rather, it is a high-stakes, computational competition to verify transactions. The Bitcoin network relies on a mechanism called proof of work (POW). Here is how a transaction goes from your wallet to being mined. Transaction broadcast, grouping into blocks, solving the puzzle, the guessing game, verification, block completion. We will discuss in detail in the next video. Stay tuned for informative videos on digital assets and investments. Like, comment, share, and subscribe. Thank you. Cryptocurrency is a type of digital or virtual currency that uses cryptography for security. Unlike the dollar or the euro, it isn't issued by a central bank or government, making it decentralized. Think of it as digital cash designed to work without a middleman like a bank. How it works, the essentials. To understand crypto, you really only need to know 3 core concepts. Blockchain technology. Imagine a digital ledger like an Excel sheet that is shared across thousands of computers globally. Every time someone sends or receives money, It's recorded on this ledger. Once recorded, it's nearly impossible to change. Cryptography, this is the crypto part. Advanced math secures the transactions, ensuring that only the owner of a digital key can spend their funds. Decentralization, there is no CEO of Bitcoin. The network is run by a global community of users and computers rather than a single company or country. Follow and subscribe for more informative videos on Speak 3. The battle between Bitcoin and traditional money fiat has evolved significantly. In 2026, it's less of one replacing the other and more about two different financial philosophies living side by side. Think of it this way: fiat is the operating system for your daily life, while Bitcoin has become the global backup drive or digital gold. Traditional money, it is centralized. Governments control the supply to manage the economy, like lowering interest rates or printing stimulus. If the government or bank fails, your money is at risk, though usually insured. Bitcoin, it is decentralized. There is no CEO of Bitcoin. It runs on a global network of computers. No government can turn it off or print more of it to pay off debt. Fiat is inflationary. Over time, your $100 buys fewer groceries because more money is constantly entering the system. It is disinflationary. Its supply is hard-coded. As of 2026, we are well past the most recent halving events, making new Bitcoin incredibly rare. The main difference between a hot wallet and a cold wallet comes down to one thing: connectivity. Think of a hot wallet like a physical wallet in your pocket, convenient for daily spending but risky to carry $10,000. A cold wallet is more like a high-security floor safe, harder to access, but much safer for your life savings. Hot wallets are digital tools connected to the internet. They are typically apps on your phone, extensions in your browser, or accounts on an exchange. Cold wallets or cold storage are physical devices or methods that keep your private keys completely offline. Since they aren't connected to the internet, they are virtually immune to remote hacking. The golden rule of storage. Most experienced crypto users utilize a hybrid approach. Keep a small amount of walking around money in a hot wallet for quick swaps and daily use, but move your savings to a cold wallet for peace of mind. As the saying goes in the crypto world, not your keys, not your coins. Is a decentralized, open-source blockchain with smart contract functionality. It allows developers to build and deploy applications called dApps that run exactly as programmed without any risk of fraud, censorship, or third-party interference. The native cryptocurrency used on the network is called Ethereum, the fuel to perform actions on the network. You pay a fee in gas. Think of this as the toll for using the network's computing power. The consensus Ethereum uses proof of stake POS, where validators secure the network by locking up their ETH, rather than using energy-intensive mining. What are smart contracts? If Ethereum is the operating system, smart contracts are the apps. A smart contract is simply a program stored on the blockchain that runs when predetermined conditions are met. Ethereum provides the Ethereum virtual machine envelope, which acts as the environment where these smart contracts live and breathe. Development, deployment, interaction, and execution. To buy crypto in 2026, steps are as below. 1. Pick an exchange. Select a platform based on your region. Coinbase is great for ease, Kraken for low fees, and MudRex or CoinDCX for India-specific regulations. This is not any paid promotion of any exchanges or names mentioned. Verify and secure. Register and complete KYC by uploading your ID. Immediately enable two-factor authentication using an app like Google Authenticator to protect your funds. Add funds. Link your bank account. Use UPI or ACH transfers to keep fees low. Avoid credit cards, as they often carry high surcharges. Buy assets. Start with blue chips like Bitcoin, BTC, or Ether Use a market order to buy instantly at the current price. Storage. For small amounts, the exchange is fine. For larger holdings, move assets to a hardware wallet like Ledger for maximum safety. Please do your own research before investing in crypto. Starting your crypto journey requires balancing potential gains with sanity. In 2026, the market is more mature, but volatility remains its defining trait. Use the core satellite model to stay grounded. 1. The allocation. 60% blue chips BTC, the gold and oil of digital finance. These are your anchors. 30% mid-cap SAW, link established projects with high utility. 10% moonshots high-risk AI or gaming tokens. Only use money you can afford to lose. 2. Strategic rules. Disqualify as a set amount monthly. Never all in on a single day. Staking puts your ETH or SOL to work to earn passive yield 3 to 5%. Self-custody, use a hardware wallet for long-term holdings. 3. The exit plan. Don't be a perma-hodler. Set priced targets to take profits. Taking 20% off the table during a rally protects you from the inevitable 40% crash. Focus on time in the market, not timing the market. Please do your own research before investing in crypto.
Bitcoin, Dogecoin, NFTs. I mean, you see these words everywhere. They're promising to be the future of money, but how do they actually work? Well, in the next few minutes, we are going to pull back that curtain on cryptocurrency and make sense of it all. Let's dive in. Okay, so here's our game plan. To really get crypto, we have to start at the beginning with how money has evolved. Then we'll nail down what cryptocurrency actually is. After that, we'll get into the magic that makes it all secure, the blockchain. Then we'll weigh the good against the bad. And finally, we'll explore the weirder side of things, like NFTs. So before we can even talk about digital money, we gotta ask a much bigger question. What even is money, you know? Its form has changed so dramatically over the centuries, shifting from something you could literally hold in your hand to something you can't even see. And that evolution is the key to understanding everything that's happening right now. I mean, just look at how our idea of money has gotten more and more abstract. We started with bartering, right? Literally, your horse for my cat. Then we moved to precious metals, something that everyone just sort of agreed had value. From there, we got paper money, which is really just a promise of value backed by a government. And today, most of our money is already digital. It's just numbers on a bank's private spreadsheet. So when you look at it this way, cryptocurrency isn't some crazy leap into the unknown. It's kind of the next logical step in this long journey towards pure digital value.
So what makes this next step so different from what we have now? Well, at its heart, it's a totally radical new take on a tool we all understand, the spreadsheet.
Okay, think about it like this. Right now, when you buy a coffee, your bank just subtracts that cost from its own private spreadsheet. The coffee shop's bank adds it to their spreadsheet. These records are totally separate, controlled by these big institutions. It's a whole system of private, walled-off gardens.
Cryptocurrency completely flips this idea on its head. Imagine, instead of all those private spreadsheets, there was just one, single, public one, for everyone. A massive ledger of every transaction ever made, and here's the crazy part. Everyone on the network has their very own identical copy of it. And that giant, shared spreadsheet, that's what we call a ledger. The fact that it's distributed, copied and spread across thousands, even millions of computers all over the world, that's what gives it its real power. There's no single person or company in charge. And this new setup unlocks some seriously powerful possibilities. Because it's totally digital and decentralized, you don't need a bank acting as the middleman anymore. This could open the door to a truly global financial system, letting anyone with an internet connection jump in and making international payments almost instant without all those crazy fees we're used to. But wait a minute, this raises a huge question, right? If there are no banks and everyone has a copy of the ledger, what stops me from just adding a line that says, "Give me $1 million"? The answer to that is in the crypto part of cryptocurrency. The security comes from this amazing technology called the blockchain. Think of the blockchain as the individual pages in that giant public ledger. Each new page, or block, has a list of recent transactions, but it also has two other super important things. First, a unique digital fingerprint called a hash, and second, it has the hash of the block that came before it. This is what creates the chain, linking each block securely to the last one. And before any new block can be added, it's blasted out to the whole network, where all these computers work to make sure it's legit. Only then does it get added to the chain forever. And this is where the security becomes almost unbreakable. Because each block is cryptographically sealed to the one before it, you can't just change one without breaking the whole chain. If a hacker tried to alter a single transaction in an old block, it would change that block's hash. That would set off a ripple effect, breaking the link for every single block that came after it. To make that fraud stick, you wouldn't just have to fix the entire chain. You'd have to do it on hundreds of thousands of computers all at the same time. It's basically a digital fortress. So, okay, the tech is incredibly secure. It's revolutionary. But that doesn't mean it's perfect. Not by a long shot. Let's try to separate the hype from the reality and look at both the promise and the peril. On the one hand, the promise is huge, a global financial system that's open to everyone. But on the other hand, the risks are very real. The prices are insanely volatile. They can swing wildly based on a single tweet. You still can't really buy your groceries with it. And then there's the environmental cost. The process of verifying all these transactions, called mining, uses a shocking amount of energy. And of course, it's always had this reputation as a tool for criminals. But about that criminal reputation, it might not actually hold up to the data. People think crypto is anonymous, but since the ledger is public, transactions can often be traced. And when you actually look at the numbers, it tells a really surprising story. This analysis found that while, a tiny fraction of crypto is used for illicit stuff, that percentage is way higher for untraceable physical cash. Now, this technology isn't just about being a new form of currency. It has unlocked this really strange, fascinating, and very new digital frontier. You have definitely heard the term NFT, non-fungible token. Well, what on earth is it, really? Okay, so a dollar bill is fungible. You can trade my dollar for your dollar, and they're exactly the same. An NFT is non-fungible, which just means it's one of a kind. It's a way to use the blockchain to prove that you own a unique digital thing. It doesn't stop anyone from right-clicking and saving a copy of the image, but the ledger publicly proves that you own the original. It's like everyone else has a poster, but you have the signed original painting. And the value people are putting on those digital bragging rights, it can be absolutely mind-boggling. A digital collage by an artist named Beeple sold at auction for $69 million. All for a certificate on the blockchain that points to a single JPEG file. And if you thought NFTs were strange, well then there's Dogecoin. This is a cryptocurrency that was literally created as a joke, based on a dog meme. But because people thought it was hilarious and started buying it, its value just exploded. And in the process, it actually made some of its earliest investors millionaires. It just goes to show you how speculative, how unpredictable, and sometimes how completely bizarre this new world can be. So here we are, full circle. We went from trading physical horses to trading digital tokens based on a meme. And it leaves us at this fascinating crossroads, staring down one massive question. Is all of this the next logical step in how we think about value? Or is it a massive speculative bubble built on nothing but hype and just waiting to pop? Honestly, right now, nobody knows for sure. We're about to dive into the story of one of the wealthiest, most influential people in all of crypto. But here's the thing, there's a pretty good chance you've never even heard his name. So let me ask you, when you think of the richest person in crypto, who's the first name that pops into your head? Go ahead, think about it. Got a name? Yeah, I'm willing to bet it wasn't this guy. His name is Changpeng Zhao, but everyone just calls him CZ. And his story is this incredible lesson in taking huge risks and having unwavering belief. This whole journey really kicks off with a bet. And I'm not talking a small wager. This was a massive all or nothing gamble on an idea that pretty much everyone around him thought was completely insane. Okay, so picture this. It's 2013. CZ hears about Bitcoin for the very first time. But unlike most people who just saw it as some weird internet thing, he saw the future of money itself. And with that kind of conviction, what do? Well, you go all in. And when I say all in, I really mean it. He took $1 million of his own money and poured every single penny into Bitcoin. This wasn't just some casual investment. It was a total, absolute commitment to what he believed in. So, how did the people closest to him react? Well, they thought he'd lost his mind. His friends were literally telling him he was crazy for betting his entire fortune on this digital currency that nobody had proven yet.
And for a while there, it looked like his friends were right. Almost as soon as he invested, the market just tanked, and his conviction was about to face the ultimate trial by fire.
The crash was just devastating. His $1 million investment plummeted by 70%. 70! It wiped out most of its value, leaving him with just a fraction of what he started with. He lost $700,000. Just like that, the majority of his net worth just vanished. Now, this is the exact point where almost anyone else would have panicked and sold everything. But CZ didn't panic. He didn't sell. Instead of reacting with fear, he responded with something way more powerful. Just relentless, disciplined focus. For the next 5 years, he just put his head down and worked. We're talking 9 in the morning until midnight every single day. He wasn't just sitting there waiting for the market to bounce back. No, he was deep in the trenches, learning the tech, understanding the architecture, and building the expertise he was going to need for his next big move. And all that persistence, it was about to pay off in a huge way. It was time to go from just believing in the technology to actually building its future. He took everything he'd learned and founded his own crypto exchange, Binance. And this company would become the engine that turned his vision into a global reality. And the growth was just explosive. In only 5 years, his company went from a brand new startup to the single biggest crypto company on the entire planet. Just stop and think about that transformation for a second. He went from being the crazy guy who lost a fortune to becoming the richest man in crypto. His crazy idea grew into the biggest company in the entire industry. This entire journey, really, it all boils down to one central idea. It's not about markets, it's not about timing, it's not even about luck. It's about the pure, raw power of conviction. So what's the lesson here for us? What's the secret sauce that lets someone take a 70% hit and still come out on top of the world? Well, here's the core of it. When you're doing something brand new, something no one has done before, what really matters isn't luck or money. It's just that deep, unshakable conviction that what you're building is absolutely going to work. So I'm going to leave you with this question, and forget about crypto for a minute. Forget about money. What idea, what project, what belief do you have in your own life with that much conviction? What's the one thing you'd be willing to grind on from 9 a.m. to midnight for, even if everyone else around you told you were crazy?
Okay, so when someone says crypto, what's the first thing that pops into your head? For most people, it's Bitcoin, right? But what if I told you that's just scratching the surface? See, crypto is living at least 5 completely different lives right now. And today, we're going to be your field guide to all of them. Let's dive in.
So let me ask you this. Is crypto just digital money? I mean, that's the common story, right? A replacement for the dollar. And yeah, that's where it all began. But thinking that's the whole story is missing the point. It's just one chapter in a much, much bigger book. And trust me, the other chapters are way more fascinating.
Of course, we can't ignore the elephant in the room, Bitcoin. Its market cap is floating around $1 trillion. I mean, that's just a staggering number. It's the OG, the one that started it all. But for our tour today, think of Bitcoin as base camp. It's our starting point, but the real adventure begins as we look beyond it. All right, so here's the game plan for our guided tour. We're going to cover 5 key areas. First, we'll look at the whole digital cash idea. Then, we'll see the coins that are literally anchored to reality. After that, we're popping the hood to look at the network's engine. From there, we'll explore how finance is being totally reimagined. And we'll finish up with the ownership revolution. Ready? All right, first stop on our tour, digital cash and coins. This is the starting point, the role you're probably most familiar with. It's the whole reason this party got started. The idea here is pretty straightforward, really. These are just digital assets that you can use to buy stuff, products, services, whatever. They act just like the money in your bank account, but in a purely digital form. It's all about a direct person-to-person exchange of value, no middleman required. And look, this isn't some far-off futuristic concept. This is happening right now. For real, you can actually use Bitcoin to buy a Tesla or grab Dallas Mavericks tickets with Dogecoin. And you've got others like Litecoin and Bitcoin Cash trying to make transactions even faster and cheaper. So yeah, people are actually using this stuff as, well, money. Okay, but here's the big problem with using something like Bitcoin for your morning coffee, right? The price is all over the place. It's super volatile. That makes it pretty tricky for everyday use. And that problem leads us directly to our second crypto species, the stablecoins. So what makes a stablecoin stable? Well, it's pretty clever. They're a special kind of crypto that's actually backed by a real-world asset. Think of it like a digital token that has a real US dollar or maybe even gold sitting in a reserve somewhere to back it up. That reserve is the anchor that keeps its value from flying all over the place. And this just says it all, doesn't it? On one side, you have the heart attack-inducing roller coaster of a typical crypto. And on the other side, the calm, boring, beautiful flat line of a stablecoin. It's designed to stay pegged, usually 1-to-1, with a currency like the US dollar. Predictable, reliable. Some of the big players in this space are Tether, USD Coin, and DAI. They act as this crucial bridge between the old school financial world and the new world of crypto. But you know, whether we're talking about a volatile coin or a stable one, they all need something to make them run securely. And that brings us to the third life of crypto, the engine under the hood. So now we're shifting gears a bit. We're not talking about what you can buy anymore. Instead, we're looking at the technology that makes the whole system work. We're talking about the powerhouse, the engine that drives so many of these networks. It's a concept called proof of stake. Okay, proof of stake sounds super technical, but the core idea is actually pretty simple. Imagine you have to put down a security deposit to help run the network. That's what staking is. Users lock up some of their own coins, and if they do a good job verifying transactions, they get a reward. But if they try to cheat the system, they risk losing their deposit. It's a really smart way to incentivize good behavior. So you can see how it works. Step 1, users lock up or stake their coins. Step 2, this gives them the right to help regulate and verify all the new transactions coming in. And step 3, once everything checks out, those transactions get added to the official public record. This process is the security backbone for a ton of the biggest crypto projects out there. And the projects running on this engine? Oh, there's some of the heavy hitters. You've got Ether, which is basically the gasoline that powers everything on the massive Ethereum network. You have Cardano, which is all about taking a slow, steady, research-first approach. And then there's Solana, which is built for one thing above all else, pure blistering speed. Okay, so we have this powerful engine. The natural next question is, what can you build with it? Well, one of the most ambitious things people are building is a parallel financial system from the ground up. This brings us to our fourth life of crypto, the wild world of DeFi. DeFi stands for decentralized finance, and the name says it all. It's about taking all the things your bank does, lending, borrowing, trading, and rebuilding them on a public blockchain. Now, why would you do that? The big idea is to cut out the middlemen, the big banks. In theory, that could mean things get cheaper, faster, and more accessible to anyone with an internet connection. So what does DeFi actually look like? Well, think of it like financial Lego blocks. You've got platforms like Uniswap, which are decentralized exchanges for trading. Then you have something like Chainlink, which is crucial for pulling real-world data onto the blockchain. And then you have platforms like Aave for borrowing and lending. You can do all of this without ever talking to a banker. And now for our fifth and final life of crypto. We've talked money, we've talked tech, we've talked finance. Now let's talk about ownership. This is the one you've probably heard about on the news, the one that's created all the buzz. Yep, we're talking about NFTs. So what on earth is a non-fungible token, or NFT? Think of it as a digital certificate of authenticity. It's a unique, one-of-a-kind token on a blockchain that proves you own a specific digital item. It could be art, music, a video clip, a ticket to an event, anything. It's like having the official deed to a digital property. And that word non-fungible is the key. It just means it's unique. You see, a dollar is fungible. I can trade my dollar for your dollar and we both still have a dollar. But an NFT is like the Mona Lisa. There's only one. And because its history is tracked on the blockchain, you can prove without a shadow of a doubt who created it and who owns it right now. This is a total game changer for proving ownership online. And this isn't just about digital art. The tech is popping up everywhere. Blockchains like Flow, Tezos, and Algorand are huge hubs for NFTs. But it's also moving into very specific niches. Data Network is using it to shake up video streaming, and Chili's is integrating it deeply into the sports and fan engagement industry. It's spreading like wildfire. All right, let's do a quick lightning round recap. We've got currencies, which is digital cash; stablecoins, the digital anchors keeping things steady; proof of stake, the powerful engine making it all run; DeFi, a whole new digital banking system; and NFTs, the revolution in digital ownership. 5 different lives, 5 different jobs. So, if there's one thing you take away from this, it's this. Crypto isn't just one thing. It's not just Bitcoin. It's actually a whole toolkit, a diverse set of tools, and each one is being used to build a different part of our new digital future. So there's the map. That's the crypto world in its 5 different forms. But the big question is, which one of these is going to define our future? Will it be crypto as simple digital cash? Or will the DeFi revolution change everything? Or maybe it's the idea of digital ownership through NFTs. What do you think is the real game changer here? Thanks for joining me on this tour. You ever look at something like crypto and just think, nope, that is way too complicated, way too risky for me? Well, we're about to walk through a story that starts exactly there, in that place of fear. And it ends with one single, simple action. It's a journey I think a lot of us can probably relate to. And this is really the idea at the heart of the whole thing. This feeling that maybe, just maybe, the average person is kept a little bit scared of the things that could actually make them some real money. It's a powerful thought. Kind of makes you wonder, right? And you know, this feeling, it's not new. I mean, think about it. Our parents or maybe our grandparents, they probably felt the exact same way about the stock market. And now, well, that same cloud of fear is hanging right over the crypto market. And the person in this story, he admits he was right in the middle of it. But then, as Bitcoin's price started to really take off, something clicked. He realized just being afraid wasn't a strategy. It wasn't getting him anywhere. So it was time to tune out all that noise and go find someone who actually knew what they were talking about. And that's when he found a mentor. So, this mentor he found had a really interesting point of view. See, he'd been quietly doing a Bitcoin SIP, a systematic investment plan, since way back in 2021. That's when one Bitcoin was only worth around $17,000. So this guy wasn't just talking theory, you know? He was actually living this strategy. So naturally, this brought up the elephant in the room, especially if you're investing in a place like India. He asked, look, with this massive 30% tax on profits and all these strict rules, what's even the point? Why would anyone bother? And the mentor's answer was so simple, but wow, it was powerful. He just said, first of all, the tax is on profits. You only pay when you sell. I'm not planning on selling for at least 5, maybe 7 years. So why am I going to worry about a tax bill today? And right there, that's his whole game plan. He's not investing for next week. He's investing for his daughter's future years and years down the line. He's making a bet that by the time he's actually ready to sell, the government regulations might be a little more friendly. But hey, even if they're not, if Bitcoin's value truly skyrockets, paying that tax is still going to feel like a massive win. Okay, but that leads to the next big question, doesn't it? The mentor threw out this idea that one day a single Bitcoin could be worth 10 crore rupees. That's over $1 million. It sounds absolutely insane. So our narrator had to ask him, okay, how? How is that even possible? So the mentor said, all right, to understand the future, let's just look at the past for a second. Back in 2014, one Bitcoin was about 30,000 rupees. Fast forward to today, in 2025, and it's blown past 1 crore. When you see it like that, suddenly that 2030 prediction doesn't sound quite so crazy, does it? And look, the logic here isn't just some fantasy. It's actually based on a really basic economic idea: limited supply. There are only ever going to be 21 million Bitcoin, period. So as more and more people want a piece of that very small, finite pie, well, the price just naturally has to go up. And then the mentor just laid it out there, a real truth bomb. He said, right now, today, an average person can still afford to buy a tiny little piece of a Bitcoin. But in the future, the common person might not be able to afford it at all. It really makes you feel like the clock is ticking, you know? So this was all starting to make sense. But there was still this one giant wall in the way. The narrator, just like pretty much all of us, thought you needed a ton of cash just to get your foot in the door. He basically felt like he was priced out before he could even begin. He just told his mentor straight up, this all sounds amazing, but I don't have that kind of money. And that's the thought that just stops so many people in their tracks, isn't it? But what the mentor said next changed everything. He just asked him, do you have 500 rupees? We're talking less than $7 US. And with that one simple question, that whole giant barrier just came crashing down. You don't have to buy a whole Bitcoin. You can start with just a tiny fraction. And that was it. That was the aha moment. Just hearing how low the barrier to entry really was, that was the final push he needed. His whole perspective shifted. He immediately went, opened an account on an exchange, and started his own SIP. The fear was gone, and it was replaced by action. And this right here is the biggest takeaway from this whole story. This wasn't some reckless, all-in gamble. No, it was a small, totally calculated risk that he was able to take because he had new information. I mean, the logic is pretty hard to argue with, right? The amount you need to start is tiny, so what you stand to lose is minimal, but the potential upside, it's enormous. And then you have to think about the risk of future regret, that nagging what if that could stick with you for years. Plus, choosing a platform that's registered and compliant with government financial rules, well, that just makes the decision even easier. And that really brings us to the final question that our narrator was left with. And it's a question for all of us, really. What if he's right? What if all this turns out to be true? What if Bitcoin really does hit those unbelievable numbers and we're just sitting on the sidelines because we were too afraid to even try? It's definitely something to think about.
So you're in crypto, and you're facing the big dilemma, right? The one everyone asks. Should I be investing for the long haul, building real wealth? Or should I be trading day to day, trying to catch those quick profits? It's a choice that honestly can make or break your entire journey. Today, we're going to break it all down so you can figure out which path is the right one for you.
And this really is the million-dollar question, isn't it? I mean, the crypto market is just wild. One minute you hear these stories about traders making a fortune overnight. But then the next, you hear about these patient investors who turned a pretty small bet into life-changing money over a few years. So which one is it? What's the actual right move here? All right, here's how we're going to tackle this. First, we'll get clear on what trading versus investing even means. Then, we're going to talk about something called the short-term trap. It's a big one. After that, we'll look at the flip side, the incredible power of playing the long game. And finally, we'll talk about what an ideal portfolio might look like and help you make that final choice for yourself. Okay, first things first, let's get the absolute basics down. You hear people throw around the words trading and investing like they're the same thing, but they're not at all. They are completely different mindsets, and getting this right from the start is, well, it's absolutely crucial. This slide just nails the difference. Think of it like this. The long-term investor on the left, they're planting a tree. They buy, they hold, and they wait patiently for it to grow into something huge over years. But the trader on the right, they're out there every day foraging for berries. It's constant action, chasing those quick wins. One is about building an orchard for the future. The other is just about what you can find today. Now, those quick daily profits, they sound amazing, don't they? Who wouldn't want that? But here's the thing. There is a huge catch. The source material calls it the short-term trap. And it's this dangerous little cycle where most new traders, frankly, get completely wiped out. This quote just captures that feeling perfectly. Imagine this. You buy a solid coin like Cardano at $150. It pops up to 180 and you think, great, I'll take my profit. You sell. Smart move, right? But then you watch it climb to 200, then 300, maybe even 400. Suddenly, that little win feels like a massive loss. And the main thing you feel isn't pride, it's just this sinking regret. And that regret, it makes you do stupid, impulsive things next time. It's a vicious cycle. But look, it's not just about your feelings. there is some cold, hard math that most short-term traders just completely ignore. And you absolutely have to understand this. Let's keep it really simple. Say you start with 100,000 rupees. You make a bad trade and poof, you lose 20%. So now you've got 80,000. It stinks, but hey, you just need to make that 20% back to get even, right? Wrong. The math is not nearly that nice. And this is the trap. To get from your 80,000 back to that original 100,000, you need to make 20,000 in profit. Well, making 20,000 on an 80,000 portfolio, that's a 25% gain. Just think about that for a second. A 20% loss forces you to get a 25% gain just to get back to zero. The deeper the hole you dig, the steeper the climb to get out. That is the mathematical trap of trading. So, if short-term trading is basically an emotional and mathematical minefield, what's the other option? Well, let's talk about the power of patience. Let's look at the long-term strategy that's actually designed to build real, sustainable wealth, not just chase after quick wins. Okay, let's use a real-world example with Matic. Let's say an investor decides, I'm just going to put in 1,000 rupees periodically, and I don't care what the price is. So look here, they bought when it was 2 rupees, they bought at 4 rupees, and yeah, they even bought at the very peak of 200 rupees. This is called dollar cost averaging. You're not trying to be a genius and time the market, you're just consistently buying in. And this is where the magic happens. Look at the math. Over those 7 different buys, they invested a total of 7,000 rupees. And get this, even though they bought all the way up at that peak price of 200, their average cost per coin is only about 61 rupees. Now that is the power of the strategy. So what does that actually mean for you? It means that even if Matic has a huge crash, say it drops 50% from its peak all the way down to 100 rupees, this investor is still in profit. Their average cost is just 61. This is exactly how you build a portfolio that can actually survive the crazy crypto storms. You're not panic selling, you're just secure. Okay, so we've seen the huge risks that come with trading and the power of long-term investing. So how do you actually, do this? The source gives a really simple, really balanced way to think about it. Here it is. The strategy is simple. 90% of your crypto money goes into your long-term holds. These are the big projects, the ones you fundamentally believe in for the future. And that other 10%, that's your trading fund, your play money. This gives you the best of both worlds, right? You build that solid foundation of wealth with the 90%, but you can still experiment and scratch that trading itch with the 10% without risking your entire portfolio. When it comes right down to it, this isn't just a financial decision, it's a lifestyle decision. It's really about how you want to live your life and where you want to put your focus and energy. This table just lays it all out, plain and simple. Short-term trading, it's super high stress, takes a ton of your time, and it's all for the chance at a quick profit. Long-term investing is the total opposite. Very low stress, doesn't take much time at all, but it requires huge amounts of patience. The goal isn't a quick buck. The goal is building real, lasting wealth. So we'll leave you with this final question. When you really think about your own goals, your own life, what are you actually here for? Are you here to build long-term wealth, or are you just chasing short-term stress? Only you can answer that one. Welcome to This Explainer. In the wild world of cryptocurrency, you hear a ton of strange terms. But believe it or not, one of the most important strategies actually started as a simple typo. Today, we are decoding HODL. So if you've spent any time at all around crypto, you've definitely seen this word. It's spammed in chat rooms, it's plastered all over memes, and you'd think it was some kind of deliberate genius strategy. But the truth? It was a complete accident. You would think a major investment philosophy would be cooked up in some Wall Street boardroom, right? Well, not HODL. This whole thing started with one frustrated post on a forum and a very simple, very human mistake. Okay, let's dive into the origin story. We're going to go back to where it all began because this famous typo, it wasn't just a mistake, it was literally the birth of a movement. Okay, so picture this. It's December 2013. The price of Bitcoin is on an absolutely wild, stomach-churning roller coaster. People are panicking, they're selling off everything, but one user on the Bitcoin Talk forum, they just decided they'd had enough and posted this passionate rant about their plan to just hold on. But here's the thing, in their frantic, whiskey-fueled emotional state, their fingers slipped. The title of the post wasn't "I am holding," it was, as you can see right here, "I am hodling." And boom, just like that, a meme was born. That one little typo just perfectly captured this feeling of defiance against all the market chaos. It became an instant rallying cry for this whole community of investors who really believed in the long-term vision, not all the short-term noise. So how in the world did a simple meme, a typo, turn into a guiding mantra for investors? Let's actually break down the philosophy behind it. So at its core, hodling is really an act of discipline. It's all about ignoring the noise. It's about resisting that gut-wrenching urge to panic sell when prices dip. And you know what? It's also about resisting the temptation to take those quick profits when they spike. Yeah, it's a total shift in mindset. You're going from the high-stress, frantic energy of a day trader to the calm, cool patience of a long-term believer. You're not trying to react to every single peak and valley. You're just focused on the bigger picture, the overall journey upward.
But why do so many people swear by this? I mean, what is the real advantage of hodling? Let's take a look at why, sometimes, patience really does pay off.
I love this slide because it shows the two very different paths an investor can take. On one side, you've got timing the market, which, let's be honest, is a frantic, super stressful, and nearly impossible game of guessing tops and bottoms. And on the other side, you've got hodling, a much calmer approach focused on the long haul. So what hodling does is it shields you from making those classic emotional mistakes. It helps fight back against powerful psychological biases like loss aversion. And maybe most importantly, it aligns your investment with the belief that this technology is still in its infancy, with its biggest growth still ahead. But, and this is a big but, hodling is not some magic bullet. It is a strategy, not a guarantee. And it absolutely comes with its own serious risks. So let's get into a little reality check.
So, is it a perfect, totally risk-free strategy? No way. Absolutely not. In fact, holding on blindly can be just as damaging to your portfolio as panic selling.
Here's the hard truth. Not every crypto project is gonna be the next Bitcoin. A lot of these projects fail, and hodling a coin that has no real value or a weak foundation, well, that's just a slow ride to zero. And this right here is why doing your own research is completely non-negotiable. See, successful hodling isn't passive, it's an active choice. You have to have real conviction in what you're holding, and that conviction can only come from truly understanding the fundamentals, not from hype you see on social media. You know, over time, hodl has really evolved into something so much bigger than just an investment strategy. It's become a genuine cultural touchstone. The community even gave the term its own hilarious backronym, Hold On for Dear Life. And I mean, come on, that just perfectly captures that white-knuckle emotional roller coaster that anyone in crypto knows all too well. It's really become a badge of honor. It signifies resilience, it signifies a shared belief in the future, and it shows a community's commitment to weathering all the storms together. And so, what started out as a simple typo has become an anchor. It's a powerful symbol of community and conviction in what is, without a doubt, one of the most volatile markets on the entire planet. Which kind of leaves us with a bigger question, doesn't it? In a world that is constantly changing and often just feels chaotic, maybe patience isn't just an investment strategy. Maybe it's the ultimate superpower.
Crypto is exploding right now. Don't miss this revolving light. Bitcoin is showing strong momentum as institutional money keeps flowing in. AI-based crypto projects and Ethereum ecosystem are gaining serious traction. Experts say this could be the start of the next bull run, but volatility is still high. Follow for daily crypto updates. Learn, invest, grow Rocket.
Okay, you need to hear this. The crypto market is sending some serious signals right now, and believe me, you are not going to want to miss what's coming next. Bitcoin is absolutely pumping. We are seeing it smash through key resistance levels, hitting multi-week highs. We're talking over $78,000. So, what's fueling this fire? It's not just everyday traders like you and me. Nope. This time, the smart money, the big institutional players, they are officially in the game. And look, you don't have to take my word for it. The proof is right there. BlackRock's Bitcoin ETF is seeing massive massive inflows. MicroStrategy just dropped another $2.5 billion on Bitcoin. And if you look on chain, the whales, the really big investors, are gobbling up altcoins like crazy. But here's the real kicker. While Bitcoin is grabbing all the headlines, this rally is so much bigger. There's a whole other corner of the crypto world that is just exploding. I'm talking about AI coins. Get this. Their collective market cap has skyrocketed past $21 billion. That is a huge wave of investment pouring into the space where AI and blockchain come together. And who's leading this charge? Well, you've got projects like Bitensor, which is building a decentralized marketplace for machine learning models. Pretty incredible stuff. Then there's Render. Now, you know AI needs a ridiculous amount of computing power, right? Well, Render is building a whole network for decentralized GPU power to make it happen. It's a game changer. And of course, we've got projects like Near Protocol, which is laying down the fundamental infrastructure for all these new AI-powered apps. The growth potential here is just wow. Now, when you hear about all these insane gains, it's totally natural to feel that panic, that urgency, that thing we call FOMO, the fear of missing out. But let me tell you, that feeling can lead to some really impulsive, irrational moves. Think about it. So many people got left in the dust during the last major bull run. The big question now is, are you going to learn from that, or are you going to be next? So, what's the smart play here? Forget chasing every pump. The real strategy is simple. Number 1, start small. And number 2, stay consistent. That is how you build actual long-term wealth in this market. So here's the main takeaway. Don't let FOMO drive your decisions. Always do your own research. And hey, if you found this useful and want to stay ahead of the game, you know what to do. Follow for daily updates. Picture this. In the very near future, the entire digital world is holding its breath. We're watching a showdown that's been 9 minutes in the making. In one corner, you have the heavyweight champion of cryptocurrency, and in the other, a machine that literally bends the rules of reality. This is the story of quantum versus Bitcoin. For years, we've all thought of Bitcoin as more than just money, right? It's digital gold. It's locked away inside this fortress of code that's supposed to be, well, impenetrable. Its entire value is built on a foundation of absolute mathematical trust, a system so secure it was meant to be the bedrock of a whole new financial world. So, what's the secret to this fortress? It's all about a special kind of cryptographic lock called SHA-256. The best way to think about it is like a unique digital fingerprint for data. It's a one-way street. Super easy to create the print, but completely impossible to work your way backward from the print to the finger. That's the magic trick that makes the whole blockchain secure. Now, that phrase right there, computationally infeasible, that's the key to everything. It's just a fancy scientific way of saying you'd need more computing power than exists on the entire planet and more time than the age of the universe just to crack it, at least with the computers we have today. You see, that single assumption that our computers just aren't fast enough, that's what this entire fortress is built on. But asking this one question, well, it changes the entire game. What happens when a totally new kind of computer shows up? One that doesn't play by any of the old rules. And here it is, the quantum computer. This thing doesn't just calculate faster, it calculates in a way that's fundamentally different. It uses the bizarre logic of quantum mechanics to explore millions of possibilities all at once. It sees that one-way street of SHA-256 not as some impossible barrier, but as a puzzle it was literally born to solve. And just like that, the attack begins. The theoretical just became very, very real. 9 minutes are on the clock. That's the estimated time for this machine to unravel the cryptographic keys that protect trillions of dollars in digital assets. The countdown to a potential digital doomsday has officially started. Now, you gotta understand, the quantum computer isn't just guessing passwords really, really fast. No, it's collapsing the entire mathematical foundation of Bitcoin security. Those unbreakable strings of characters, they're starting to fracture, splintering apart and revealing the secrets they were designed to protect forever. The clock lurches forward. We're only halfway through, but the damage is already cascading through the system. Every broken key is another crack in the dam, and the pressure is building. The panic? It's starting to spill out from the digital world into the real one. This was never just about code, was it? It was always about confidence. And as the system's integrity starts to fail, so does the market's trust. The value of global crypto just plummets into an absolute freefall. Fortunes that took years to build are being completely wiped out in a matter of minutes. We're in the final moments now. The entire network is descending into chaos. The fortress is about to be completely overrun. The digital gold is exposed. Zero total system compromise. But is that really the end? For a lesser system? Yeah, absolutely. But the core idea of a decentralized network isn't just security, it's resilience. This isn't a story about extinction, it's a story about evolution. From the fragments of the old system, something new starts to emerge. Something stronger, hardened, shielded. The solution? Well, you have to fight a new kind of math with an even newer kind of math. The system begins to transition to what's called quantum-resistant cryptography. And these aren't just small upgrades. They're based on entirely different mathematical problems that are believed to be hard even for a quantum computer to solve. A new, much stronger fortress is being built right before our eyes. You know, in the world of technology, threats and defenses are always in this constant dance. The quantum computer was a catastrophic threat, for sure, but it forced an essential adaptation that, honestly, people knew was coming. The network didn't just survive, it was reborn, and it's now stronger than it ever was before. So the ultimate question isn't whether Bitcoin or any system can be broken. The real question is, can it adapt? The future of security, of finance, of technology itself, it's not about building walls that can last forever. It's about building systems that are resilient enough to evolve. Which makes you wonder, what's the next threat that will trigger the next evolution?
The choice between centralized and decentralized systems is the fundamental fork in the road for anyone entering the crypto space. It's essentially a trade-off between convenience and control. 1. Centralized crypto CEX. Centralized exchanges like Coinbase or Binance act as a middleman. They function similarly to a traditional bank, where you trust a company to hold your assets and execute trades for you. How it works: you create an account with an email and password. The exchange holds the private keys to your wallet. 2. Decentralized crypto DEX and DeFi. Decentralized finance DeFi removes the intermediary. You interact directly with the blockchain via smart contracts using your own private wallet like MetaMask or a hardware wallet. How it works: there is no company. You connect your wallet to a protocol like Uniswap and trade peer-to-peer. Please do your own research before investing in crypto. For beginners entering the cryptocurrency market in 2026, experts generally recommend focusing on blue chip that have high market capitalization, proven track records, and significant institutional backing. Bitcoin BTC, often called digital gold, it is the most established cryptocurrency. With the maturity of spot ETFs, it is now considered the base asset of the crypto market. It has a capped supply of 21 million, making it a hedge against inflation. Ether, the leading platform for smart contracts. It powers most decentralized finance DeFi and NFTs. Buying it is often viewed as a bet on the underlying infrastructure of the future Internet Web3. Solana is all known for being incredibly fast and having low transaction fees. It is currently a major competitor to Ether. Is popular for retail users because it's cheaper to use for small transactions. Crypto isn't just a currency, it's a vote for a decentralized world. Own the future of money. Think of a crypto wallet not as a physical wallet that holds cash, but rather as a digital keychain. Contrary to popular belief, a crypto wallet doesn't actually store your Bitcoin or Ethereum. Your digital assets live on the blockchain. The wallet simply stores the private keys, the secret codes that prove you own that crypto and allow you to move it. How it works: the two key pieces. Every wallet generates the strings of characters that function like an email address and a password. Public key though. Address like your bank account number or email. You share this with others so they can send you crypto. Private key, the signature like your digital signature or PIN. This stays hidden. If you lose this, you lose access to your funds forever. If someone else gets it, they can take everything. Custodial, a third party, like an exchange, holds the keys for you. Not just a duly, you have total control over your keys. Please subscribe, like, share, and comment for more interactive videos.
Imagine this. One day, you open your crypto app, you go to make a trade, and your funds are completely frozen. No warning, zero control. Sounds terrifying, right? Well, that's exactly why smart investors are moving to decentralized exchanges. No middlemen, no KYC, just full control. But here's the catch. Not all of them are safe or even worth using. Welcome back to The Explainer. Today we're diving into the 2026 DEX Masterclass to completely change how you handle your digital assets. We're breaking down the absolute best platforms out there right now and the ultimate Web3 security stack to keep you safe. Let's get started. So, what really happens when your crypto app suddenly freezes your funds? We've seen this play out time and time again, haven't we? Centralized exchanges collapsing overnight, locking users out, or suddenly demanding intrusive KYC documents before you can even touch your own money. That fundamental flaw, relying on some central middleman who actually holds the keys to your wealth, is exactly why the smartest money in the room is migrating to DEXs. But what exactly is a DEX? Simply put, a decentralized exchange is a platform that uses smart contracts to let you trade crypto directly from your own self-custodial wallet. It completely eliminates those centralized middlemen. The key phrase here is smart contracts. Instead of trusting some faceless company or a bank with your funds, you're trusting a mutable code running on the blockchain. You actually own your crypto. No account freezes, no withdrawal limits, ever. Here is our roadmap for today's explainer. 1. The case for DEXs. 2. Gateways, specifically wallets. 3. The heavyweights of the space. 4. Specialized trading. And finally, 5. The Web3 security stack. Let's jump right into number 1. Section 1. The case for DEXs. Let's look at why this massive shift is happening right now. Past exchange collapses have been, well, a brutal wake-up call for the industry. And they've driven investors to prioritize 4 specific advantages. First up, full custody and control. Like they say, your keys, your coins. Second is global permissionless access. Literally anyone with an internet connection can participate no matter where they are in the world. Third, you get much faster smart contract-driven transactions that settle instantly on-chain. And fourth, absolutely no KYC or know your customer requirements. You don't have to hand over your passport or wait weeks for identity verification just to make a simple trade. Moving on to section 2, gateways, wallets, because before you can trade, you need a way in.
Think of a self-custodial wallet as your personal gateway to DeFi. The two absolute titans here are MetaMask and Trust Wallet, but they're actually built for very different types of users. Let's break it down. MetaMask is the powerful browser-first standard. It's deeply integrated into the Ethereum virtual machine and DeFi ecosystems, and it's got incredibly robust hardware wallet support like Ledger and Trezor. The catch? If you swap directly inside their app, they charge a 0.875% service fee. Now on the flip side, we have Trust Wallet. This one is a mobile-first experience. Out of the box, it supports over 100 different blockchains. Bitcoin, Solana, EVM chains, the whole shebang. Plus, it has 0 extra swap fees, making it highly beginner-friendly. So, rule of thumb, use MetaMask for deep, desktop-based DeFi, and Trust Wallet for seamless, multi-chain mobile management.
All right, section 3, the heavyweights. Let's talk about the absolute giants of general-purpose trading. Uniswap and PancakeSwap. These are the 2 biggest general-purpose decentralized exchanges on the market right now. First up, Uniswap. This is the undisputed king of Ethereum and Layer 2 networks. It literally pioneered the automated market maker model, and it's sitting on a massive $6.5 billion in total value locked. It's your go-to for deep ERC20 token liquidity, and their V4 introduces these awesome customizable hooks for advanced pool behaviors. Then you've got PancakeSwap. Built primarily on the BNB chain, PancakeSwap carved out a massive retail user base simply by offering incredibly low transaction fees compared to Ethereum. With $2.8 billion in TVL, it's this broader DeFi hub with yield farms, lottery features, and staking, making it a huge favorite for budget-conscious traders. And speaking of Uniswap, whether you're routing orders on a single chain or across multiple chains, their new Uniswap X protocol is a total game changer. It uses off-chain signatures so that fillers actually pay your gas fees. Yeah, you heard that right. This ensures you never pay for a failed swap again. Instead of you submitting a transaction and paying network gas, you just sign an order. Then, a network of third-party fillers basically compete to execute it, paying the gas to put it on chain and recouping it in the execution price. It's an incredibly elegant solution that completely removes the headache of managing gas tokens across all these different networks. Now for Section 4, Specialized Trading. Let's look at platforms built for highly specific financial strategies. We are comparing two absolute powerhouses here, Curve Finance and DYDX. Curve is basically your safe harbor. It specializes in stablecoins and correlated assets, using a highly efficient AMM to make sure you get incredibly low slippage, even on massive trades. On the flip side, we have DYDX. This one is for serious pro-level traders. It specializes in perpetual futures, utilizing an order book model that lets you crank up to 10x leverage. And hey, notice that third row. Neither of them requires KYC. You get total privacy. Now take a look at this number, $4.3 million. That is the average monthly fee revenue generated by Curve Finance alone. And here is the real kicker. They share 50% of those trading fees directly with users who lock up their tokens, known as VCRV holders. It's a really powerful revenue sharing model. Although I should mention, the CRV token itself does suffer from a bit of inflation, which kind of dilutes some of that value capture over time. Shifting over to DYDX, we're looking at a platform that genuinely rivals the smooth user experience of a centralized exchange. It literally runs on its entirely own dedicated blockchain, the DYDX chain, to ensure maximum speed and throughput. You use USDC as your primary trading margin, and it offers both isolated and cross-margin modes. Guys, it easily processes anywhere from $28 million to $700 million in daily volume. It gives you that lightning-fast, centralized feel, but, and this is absolutely crucial, you keep total 100% custody of your funds. Which brings us to our final part, Section 5, the Web3 security stack, because protecting your assets is everything. Look, in Web3, massive freedom comes with massive responsibility. You are your own bank, which means you are also your own bank's security guard. Let this staggering number really sink in for a second. $17 billion. That's the amount of money lost to crypto airdrop scams in 2025 alone. The FBI has even had to issue explicit public alerts about this. Free tokens have literally become the absolute most dangerous entry point in all of Web3. To protect yourself, you really need to understand how the two main attack vectors work. First step are wallet drainers. These are pixel-perfect fake phishing sites. You think you're claiming a sweet airdrop, but connecting your wallet triggers a malicious smart contract that steals all your tokens in seconds. Second, and honestly much more subtle threat, are malicious approvals. You sign a transaction that looks totally normal, maybe for an NFT mint or a token swap, but hidden inside is a request granting the hacker's contract unlimited permission to spend your specific tokens indefinitely. They don't even have to steal it right then and there. They can wait weeks and just drain your account while you're sleeping. No joke. But don't panic, because here is exactly how the professionals avoid getting drained. Let's walk through this highly actionable 3-layer defense stack. Step 1, verify the sender before you click absolutely anything. If you get a random airdrop, take the sender's wallet address and plug it straight into chainaware.ai. It uses AI to check the behavioral fraud history of that sender on the blockchain. If they have a shady history, ignore it instantly. Step 2, screen the claim. Use a browser extension like Scam Sniffer or a wallet integrated with Blockade. These tools actively block known phishing domains and actually simulate the transaction outcome so you see exactly what will leave your wallet before you hit approve. Step 3, revoke and monitor. After you interact with any protocol or claim an airdrop, make it a habit to go to revoke.cash within 24 hours. Connect your wallet and cancel any open unlimited token approvals so hackers can't exploit them down the road.
Embracing decentralized exchanges really is the true path to financial freedom in crypto. You remove the middlemen, you drop the fees, and you take full ownership. I want to leave you with this final thought. In Web3, control is power, but vigilance is your armor. Trading safely on DEXs is just the first step. If you want to build real, generational wealth in crypto, trading is just one part of the puzzle. The smartest investors are using a simple strategy called Bitcoin SIP, investing small amounts regularly. But hey, that is a masterclass for another day. Make sure to check out my next explainer, where we dive into how to grow your wealth using Bitcoin step by step. Are you ready to take control of your crypto? Thanks for joining me today. Stay safe out there and keep learning.